CEO, Chairman, and President Lance Fritz, as that stock actually jumps about 7% on better than expected first quarter earnings. Lance, thanks for being with us this morning.
Thanks for having me, Morgan. It's a pleasure to join you.
So as I mentioned, the stronger than expected results for the first 3 months of 2020, you did say that you expect volumes to fall 25% in the current quarter year on year, given what we're seeing in terms of this economic downturn right now. How are you navigating that? Where are you seeing the weakness? And how is precision scheduled railroading, which has been such a big transformational trend across North America at railroads such as yours, playing a role in helping you to get through this?
Well, you're spot on, Morgan. We did have an excellent first quarter, and it's such a surreal environment where we can put up numbers like that. We had down volume, about 7%, but we grew operating income by about 9%. We increased cash generation by about 10%, and we improved our operating ratio to a record 59%. So, put that in context, that gives us a lot of confidence. That tells us what we're doing with PSR is creating a more efficient, much more reliable, better service product. Then at the tail end of the first quarter, we started seeing the dramatic impact of our reaction in the United States to the COVID-19 pandemic. And so our volume has dropped off dramatically. Unprecedented is a word that's used a little bit too much sometimes. It's absolutely the perfect word for what we're experiencing right now. So we're down right now about 22%-ish on our volumes. And what we said on our call this morning is that could be about 25%-ish for the second quarter. And I think it's going to be broad and across the board. There will be a few areas that might still be areas of strength. Roadway construction is driving a fair amount of rock. There might be a couple of other pockets, grain, if China continues to be in the market. But broadly, automotive has been hit with their shutdowns. Our international intermodal inbound because of the retail impact. Domestic intermodal is being impacted because of the broad economic impacts on domestic manufacturing. So it's really a pretty broad impact. And the way precision scheduled railroading is helping us is starting 18 months ago, we became much more efficient and much more agile at being able to take action quickly to adjust to the volume.
And certainly investors in Wall Street have responded to that as well. I think part of the reason that the shares are jumping as much as they are today. But when you use a word like unprecedented, and given the fact that you do move so many different goods that affect so many different parts of the economy right now, it's pretty broad-based consensus, at least among economists, that we are in a recession of some kind. Currently, from your vantage point, what are those flows of goods telling you about what this economic downturn actually looks like, and what specifically are you watching for in terms of recovery?
Yeah, boy, that's the great unknown. So what's truly unprecedented was the rapid pace of decline and the depth of decline. You know how tightly connected we are to the overall economy, how our role in building America really has us touching virtually every aspect. And to be down 22-25%, that says exactly what's going on in the economy. Our concern now is down how deep for how long. We've made a lot of adjustments to our cost structure from frontline workers to adjust to the amount of work we're doing in the field to we've announced here for our managers a required unpaid leave of absence 1 week a month for 4 months. All the executives in our board are taking a 25% pay reduction. That's all in an effort to try to match the current volume. And now the question is, how long is that going to last? And I, like you, have heard very, very intelligent economists, lots of experience, go anywhere from good reason to believe there's a V, to good reason to believe there's a U, to good reason to believe there's a long and slow ramp, a hockey stick. So I'm not sure exactly what to believe. Our job is to be prepared for whatever it is.
Yeah, and of course the other big focus or story that's playing out right now is the collapse of the energy complex. Obviously, you move a lot of product that's tied to things like fracking, be it crude or sand or steel. How is that affecting volumes? Are you seeing any kind of signs that we are seeing a slowdown in terms of production or energy usage?
Yeah, by all means. We've definitely seen the spreads compact, and so we were helping move crude oil from Canada down to the Gulf Coast. That's in the process of drying up because of the reduced activity in some of the Permian Basin, some of the other shale basins. We're seeing frac sand demand dry up. We're also seeing demand for pipe and pipe projects that go directly into the oil country dry up. So it's having a pretty broad impact across the board.
And Lance, given the fact that freight railroads like yours... Oh, go ahead, Sarah.
Oh, I just wanted to follow up on the oil story, Lance. Are you guys, I mean, there's so much being discussed out there in terms of ways that oil could be stored right now. Is that an option for rail cars, tank cars, to actually store oil? Because that seems to be some of the bottleneck and the problem right now, which led these prices to go below zero.
It's really not an option to store oil in tank cars on railroads. There are federal regulations that deal with the need to move that kind of product and not let it stand or sit in one particular area for too long. So it fights against current federal regulations, so it's really not an option.
And finally, Lance, I just wanted to say thank you for joining us today exclusively. Shares of Union Pacific are up about 6.8%. The railroad is an essential business, so you've continued to keep those trains moving and workers safe, and we appreciate your time this morning.
Thank you, and I'm very proud of Team Union Pacific for what we're doing during this crisis.